man, I really want to know what's going on with OpenDoor.
I think the way to start the story is very simple. I'm going to show you a stock chart, and then we're going to talk about meme stock status. And then from there, we'll break into the CEO change and so forth. But
yes,
to give everyone an idea of what we're discussing here, this is a chart of OpenDoor's price on the public markets since it went public back in, I think it was 2020, Jason. And as you can tell, a lot of very interested traders during the ZERP era. And then after that, a long period in the wilderness, all the way down to the company was worth about 55 cents a share. And then this July, suddenly it became a meme stock. Now, in total dollars.
During the ZERP, when it went out in 2021, I believe it was a SPAC, I'm not certain. And it was $30 a share during that peak ZERP era. Everybody knows the peak ZERP era ended in 2022. You had Silicon Valley Bank collapse, a bunch of hand-wringing about stocks, yada, yada. And so it just was kind of heading down to zero. And if we were to zoom in and just look at the chart for 2025 or last 6 months, it would look tremendous, right? Going from 55 cents to 350 is like a 6 or 7 bagger, which is crazy. Okay.
Yeah.
And then maybe explaining what OpenDoor does. Because I always love the idea. I mean, I can explain it too. I mean, I'm pretty well aware of the company. Yeah. Explain it.
So OpenDoor takes in a lot of information to understand the value of houses. And then if you want to, you can go to OpenDoor and say, I'll sell you my house. They'll make you a very quick all cash offer. And then they have a pretty cool plan. They take about, I think, 90 days, Jason. They go into your house, tidy it up, do some improvements, painting, etc., and then sell it again. Essentially, they are trading on their intelligence and ability to know a correct price to pay for a house that they can then resell quickly. Therefore, they don't carry a lot of inventory on the balance sheet. It's relatively asset light compared to what you might expect. But the company has struggled in the last couple of years. So I'm curious, where do you think they went wrong?
Well, timing, like if you have to pick anything in business, timing is a key. Going into a high interest rate market where homes are considered by buyers overpriced and considered by sellers underpriced, and every seller thinks their home is the most beautiful baby ever, and this is going to be president of the United States and going to win an Oscar in the same year. So I think that was the problem. They went out, rates went up, and then you have what you see today, which is a lot of people do want to sell their homes. A lot of people probably want to buy homes, but because the market's frozen with 7% mortgages, it's just not happening, folks. So if you don't have a lot of transactions, additionally, at that time, you remember Blackstone, Redfin dipped into this, and they got out of it very quickly. I think Zillow went into it. People started buying and sitting on homes, renting them, and people thought this would be a great use of capital. If single-family homes only go up and they're an incredible asset, well, we're going to buy them. And so, it's not a very fluid market. And when you look at asset light, asset heavy, they tried to be asset light by moving the inventory quick.
Yep.
But I don't think the inventory moved quick. So then now you're asset heavy, right? Because you're sitting on homes. And it probably sounds like execution. And it looks like actually Chamath did that SPAC, and it went out at a $4.8 billion valuation. So great idea. Great backers. I mean, there was so much going for this, but timing does matter. And so then it seems to me like there was probably some mismanagement, I'm guessing, at some point in this, or not reacting fast enough to the game on the field. And when a company this young, I wonder what year they were in when they went public.
I think it was 2020, but I'll grab that date for you.
So it's like a 4-year-old company that went public. This is one of the challenges in a private market, Alex. We have time to figure things out. And we do that behind closed doors. When you're a public company, you're doing it quarter to quarter. You don't have predictable revenue. You have a market that can change rapidly and deteriorate rapidly. And then can you make it through the storm? In the movie business, you have a slate of pictures, right? I was just reading Barry Diller's biography. It's incredible. Barry Diller always talked about just having enough money to make it through the variance. So if you had a bunch of summer hits and they were all stinkers, you got next year, you got another swing at bat, and then you have the year after. So if you had 3 or 4, summers or 3 or 4 years of capital to kind of blend out the spikiness of the picture business, the hit-based business, you could do it. I think there's probably something in the real estate business that's akin to that.
I think you're right. Also, Jason, the SPAC merger was December 21st, 2020. And you're right. It was Chamath's Social Capital, Head of Sophia Holdings Corp. number 2 that did the deal.
Yeah. And it was a young company. I see here they were founded in 2014, went public in 2020. So this is like, less than 6 years, which is the dream. We want to see companies going that way, but this one didn't have predictable revenue yet. So they obviously didn't have the model perfected. Maybe they should have stayed in the lab for another 6 years or 4 years or 2 years. Who knows?
Maybe. I have a chart now comparing OpenDoor's market cap and its cash only quarterly on hand. So this does not include restricted cash, I believe. But here's the chart. And as you can see, there was a period of time in which the company's market cap was indeed below its cash balance. That was quite recently.
So the gold line is market cap. The purple line is cash.
I'm so sorry, Jason. What did we talk about before the show today? All right. So today, here we have a chart showing two things. One, OpenDoor Technologies' cash balance and also its market cap. If you're watching the video, the purple line is the cash and the orange line is the market cap. Mostly throughout the company's history in the last 3 years, Jason, we've seen market cap be ahead of its cash balance, implying that the company itself has value. But recently, before its meme stock explosion, the company's cash balance did outstrip the company's market cap.
And even if it's the same, when you take out the cash, even if it was 20% more valuable, that you're just basically saying this company is worth almost nothing.
Almost nothing.
Almost nothing. You're giving zero credit to management. And, those become really attractive opportunities. I think Nextdoor fit into this category since you're really good at pulling up those charts. Pull up the chart for Nextdoor and then,
same data there, Jason?
Same data, but for Nextdoor, this is a really, and then we'll pick a strong company. Like maybe we'll pick, I don't know, Uber or Airbnb next. Because this is a really interesting chart you're creating that people can learn from. A lot of times you net the cash out for a company before you actually look at their valuation. So for a company like Apple that might be sitting on 300 billion, 500 billion, like seriously large amounts of capital, if they're worth 3 trillion, you got to say, okay, well, 10% of it, 20% of it is the cash on the books, right?
Here is Nextdoor, and I made an improvement this time around, Jason. This is actually cash and short-term investments, which is how we generally define corporate cash and market cap. The previous chart was probably a bit too conservative, but here is Nextdoor. Same thing as before, folks. The purple line is going to be cash and short-term investments. The orange line is market cap. And in this case, once again, we are seeing a company, Nextdoor, where at times the market cap has been dramatically underneath the cash balance. So
what's the market cap of Nextdoor right now? I had traded Nextdoor a little bit. I made a little bit of money.
$413 million.
Yeah, I mean, that was supposed to be like... Yeah, I wonder what that was worth in the private markets at its peak, a couple of billion. This is one of Bill Gurley's companies. Great idea, but Nextdoor, I think, had a monetization problem. Do you use Nextdoor, Alex?
I do not, but I have friends that do, and I'm a big fan of the what's that Nextdoor Twitter account, Jason, that everyone loves? Best of Nextdoor. Yeah.
Best of Nextdoor, which is like, here's like Karens doing Karen stuff when they think they have a private social network, but there's a screen grab feature on everybody's phone.
Turns out.
They just came up with a really bad business model, which was like advertising. When you have a small amount of page views, et cetera, advertising is bad, but then you have things like Thumbtack, which have just incredible monetization, or other local services companies. So I think they tried to get more into local services and, other stuff. But yeah, this is a really interesting trend. All these great assets sitting out there. If I had another career in me, I would raise, $10 billion from private equity and own, tell them I want to own 30% of the company or so. And then I would just go buy assets like this and run them like Barry Diller did at IAC, run them with like crisp leadership with a very, narrow focus to figure out what is the pony inside of this, there's got to be a pony in there somewhere. Like there's got to be a unicorn in here somewhere. Like let's find the inner unicorn. Let's find that pony and turn it into a unicorn. Okay.
Yeah.
So good luck to the folks at OpenDoors. Obviously, you can give a CEO 2 years, maybe 3 to figure this out. But as a public company, I mean, yeah. Oof. Hey, listen, we meet a lot of early stage founders here at Launch, my investment company, and some, they don't have a lot of traction yet. They just have an idea. Maybe they haven't even finished their product. They've just got an MVP, but they still need investors and accelerators like ours to take them seriously. And you know what? We can't just wire money to your Gmail or your PayPal. That's not how it works, folks. We need to know that you're a legit and official business. We need to know your company is incorporated.
That's why you need Northwest Registered Agent. It's the service that will help you run your business the right way from day one. In 10 clicks and in under 10 minutes, you're going to file for your LLC or a C Corp if you're a startup, get a domain name, launch your official website, claim your business email, and even fast track your trademark application, which some people forget to do. We're talking about more than just company formation. This is your entire identity as a business. Go to northwestregisteredagent.com/twist and show the world you're in business. And make sure you use that URL /twist so they know that we sent you.